Hello there, and welcome back to another quick economic update from here at Excalibur. This is kind of in addition to the post that was made last week, so if you haven't checked that out, please do. Also on our website or our YouTube page. But again, just want to rehash some items and then also provide a little bit more detail into our thinking and keep our clients as up to date as possible. Prior to this crisis, there were a lot of good signs, a lot of positive things going on in our economy. GDP growth was positive. We did see low unemployment, rising wages. Banks and finance firms were well capitalized and had healthy balance sheets. There was a high consumer confidence, which is certainly important for us in the US. And interest rates were at a reasonable level, again, providing some growth. So we do think that there were certainly some positives out there going into this, so we were kind of in good shape moving in. And on the downside, this is certainly a unique scenario and no one saw coming, so there is no investment playbook on how to best manage it. Especially now, consumer confidence has been shaken. Government's telling us to stay home, basically only go outdoors or buy things if they're essential only. So that's certainly hurting things in the short term. Many events are being canceled, sporting events, social events, weddings, things of that nature are all being canceled and postponed to further later in the year. And then it's still even unsure if things will be kind of settled down by then. We also think a lot of these smaller companies, quote unquote, zombie companies that were possibly not in the best financial condition to start with are likely going to go away or disappear after all this is done. But that's pretty typical in terms of these slowdowns. Those companies tend to fade away as part of that cycle. This is a report, again, you're all familiar with and I've seen before, just been updated as of last week's close. Equity side, still on a year, everything is down, but pretty positive on a one-week term. Some of that might be attributable to the strong work and quick work of the U.S. policymakers, rolling out a very robust stimulus package and getting that out very quickly. Perhaps a different story when compared to 07 and 08 when they might have taken a bit more time than they needed to get that done. So we've seen policymakers do a great job in getting that out to us very quickly. Here's a look at the fixed income or the low risk kind of area of the markets. Year-to-date basis, we do see U.S. aggregate bond index is up around 4%. An area we did add to, as I mentioned in the previous blog, part of our defensive tactical adjustments, we did add towards high quality short duration holdings, which again are one of the few areas in all the indexes that are up, and we can see that would certainly be included in this bond index. So pretty positive to see that area again has done well. As mentioned before, this would be a shorter kind of video, just kind of quickly going over some numbers, but in the long run, as we kind of move into this, still seeing reports and news come out daily as to when the U.S. economy is going to be reopened. People can start going back to work and kind of things start to wake back up, but we're still unsure as to whether this recovery will be a V-shaped or a U-shape, basically meaning, how quickly are we going to bounce back or kind of sit towards the bottom? And we certainly aren't sure how that's going to turn out one way or the other. But every week that passes, we are certainly closer to the inevitable recovery. A couple scenarios that have been tossed around would be a V-shaped recovery, possibly see maybe a 5% decline in GDP growth, and much more minimal reactions in terms of the S&P 500, as opposed to a U-shaped recovery, where things are just spend a little bit more time towards the bottom there. And I do know former Fed Chairman Janet Yellen was projecting that we could possibly see a 30% decline in GDP growth, which could result in U.S. equity markets falling between 40 to 60% range. So, there's a couple different variables out there. As I mentioned before, no one does have an investment playbook and knows best how to handle this. But again, we're doing our best to make maneuvers to further protect your principal, and are certainly monitoring all the situations on a minute-to-minute, day-to-day basis. So the more we know, we'll keep putting these videos out there for you to look over and kind of digest. And if you do have any questions, please reach out. Again, our phone number and website is listed here on this slide, so please do not hesitate to reach out. In the meantime, wishing everyone remain safe and well. Thank you.